Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and in today's episode, we're going to make a quick video going over some new piece of news that just came out within the last week or two. And the news that I wanted to go over three big dividend raises. One of them being Caterpillar, that was just announced this morning from the time that I'm filming this video on June 9th. They did raise that dividend about 8% or so, and I want to be going over that. We'll also be going over the company that I do not own. This is one that I've talked about many times, one that I've been eyeballing for the past year now. I'm just looking for a buying opportunity. This one has been on my watch list and will continue to be one that I'll watch very, very closely. But this one raised an incredible amount, and we'll go over that in a minute. And then we'll also go one of my largest holdings. One of my largest holdings about 2 or 3 weeks ago announced not only a new dividend raise, but also they announced a new share repurchase program. I'll go over why this is even better news for dividend investors and for Home Depot shareholders, and I'll be going over all the reasons why I believe Home Depot is going to be a great investment moving into 2021 and beyond. And then last but not least, away from dividend raises and share repurchase programs, we'll go over a piece of news that is one of the biggest piece of news with my second largest holding that was just announced just 2 days ago, and that is that W.P. Carey is announcing pricing of a public offering of common stock. They're going to be diluting shareholder value. They're going to be offering 5.25 million shares worth of common stock, and they're going to be using those proceeds for different things. And we'll talk about that in this video. But before we jump into all that, if you're not familiar with me, my name is Jordan. These are the companies that I own. These are the annual and monthly dividend income that I track. These are the charts that I update every single month. These are my 5 investing goals for 2021, my 2021 stock market prediction. If you want to get signed up with M1 Finance, this is the brokerage that I use in all of my videos. This is the platform that I know and love. It's absolutely free with great features. If you want to get signed up, we've signed up 112 people so far. So if you want to go down below in that description, it gives you $30 for getting signed up if you want to go ahead and use that. And there's also other things down below as well as my email if you want to sign up for a mentoring call. You got savings accounts, credit card referrals, all that stuff. So thank you guys for tuning in. And let's go ahead and jump into the first piece of news, which is Caterpillar stock. Now, Caterpillar stock is a company that I own and is currently, I believe it's 2% of my portfolio. We scroll down here and we go to Caterpillar stock. We can see that it was one of the best holdings in my portfolio in 2020 and the first half of 2021. On a money-weighted return, which like I said before, I always like time-weighted returns much, much better. But on a money-weighted return, we are up 118% on this company. Total gains are at about $203, $195 of that coming from market gain, $7 and some change coming from earned dividends, and we just increased the amount of passive income that we earn in this company without even putting an extra dime in. And this company has had incredible performance over the last couple of years, especially in 2020 and early 2021. And one of the main reasons for this is because of the potential for an infrastructure bill. This company is benefiting massively from the possibility of the Biden administration passing that form of stimulus. Now, that bill is going to be valued in the trillions of dollars with a T, and this is why this company is rallying. The previous all-time high of this company was in 2018, in January of 2018, at around $170. Since then, it has broke past those levels, past 200, past 220, past 230, and now we're eyeballing 240, $250 a share, and the dividend yield has went down and down and down because the dividend payment did stall a year from getting raised. They usually raise it every July. Every year in July they raise the dividend, but in 2020 they paused raising that dividend just for 1 year to make sure that they had enough cash to fund operations going into the pandemic. And that's perfectly fine. That's not an issue with me whatsoever, especially considering that this company raised its dividend like over 20% in the summer of 2019. So that is perfectly fine. Now moving forward, I've mentioned in previous videos that I said that Caterpillar was going to be raising its dividend likely very big in 2021, but more importantly in 2022, 2023. I think that next year it is very likely, I could be wrong about this, but I think it is very likely that we will see a 10+% raise in 2022. I could be wrong, but that's especially if the infrastructure bill passes, like a lot of people are betting that it will. But right now they did raise that dividend about 8% roughly, and that is going to be another great benefit for shareholders as this company continues to buy back stock and this company continues to pay out dividends. You can increase wealth as a shareholder to stay invested with this company. And one of the best things I love with an opportunity like Caterpillar is that it's not just dividend prices going up because the management team has made a commitment of raising it. This is one of the opportunities where the reason that the stock price is going up is just flat out the business is thriving. If you have a stock that has a lagging business, they can't pay dividends, they can't raise them over time, and this is a company that has a business that is thriving. So I'm glad that Caterpillar raised that dividend, and I'm looking forward to getting those higher payouts. Now, next up, speaking of businesses that are thriving, we have the only company that we're going to talk about today that I do not own, one that I've eyeballed for a long time, pretty much since I've been in the stock market. In my opinion, it's kind of like the better version of Walmart in some ways. It's a little bit different of a company, but it's a lot like a Walmart in a way. And this company has a track record of paying dividends as of now, with today's raise, 50 years straight of raising that dividend every single year. That's right, Target is now officially, as of this morning, a dividend king. 50 years of raising that dividend every single year. And to celebrate its 50th year of raising dividends, it did not raise a dividend a normal amount, what's typical in the stock market or for Target, of 5, 6, 7, maybe even a higher grower dividend payer raising it 10% a year. This company raised its dividend payout 32%. 32.4 to be exact. It raised its dividend by almost a third. The previous payment of 68 cents got raised to 90 cents. And so now the new yield of this company, if we can take out my calculator, let's take out my phone, and let's take the new payout of 90 cents and multiply that times 4. So 90 cents times 4, you get $3.60. Divide 3.6, divide that by the current share price of, let's just say, 232. This has a current forward dividend yield of 1.55%. So that is much higher than what it shows here on M1 Finance. Gives incentives for investors to buy the stock even at all-time highs. Just 1 year ago, just 1 year exactly today, back in June 9th of last year, this company was $122 a share. Almost half the price of what it trades now. So this company has had a massive uproar in share price. They're benefiting massively from the stimulus checks and the enthusiasm that investors have towards this company. And this company just continues to find ways to increase profitability, increase wealth to shareholders. Like I said with Target, this is another opportunity as an investor to invest in a business that is growing. Not in a dividend and a share price that's growing. Yes, that falls alongside it. But this company's fundamentals, the underlying business of this company is thriving and hitting new all-time highs on the business side of things pretty much every single day. So hats off to Target shareholders. If you own this company, congratulations on the massive 32% raise, which is just mind-boggling. So congratulations there. Next up, as far as dividend raises go, we have the last one that we're going to talk about here, and that is Home Depot. Now, I covered on the channel a little bit while back, that this company announced that they'll be raising that dividend exactly 10%. The previous payout was $1.50, and now they're going to be paying out $1.65 every single quarter. Now, when they declared that dividend, they also announced a new share repurchase program of $20 billion. This company is going to be buying out a lot of its own shares directly back into the company. And while this company might be paying out its 137th consecutive quarter of paying a cash dividend, which is already impressive enough, you know that when companies buy back their own stock, as well as paying out dividends, it's the ultimate form of income and wealth creation as a dividend growth investor. Because multiple things happen. Home Depot's business is going to grow over time. As inflation goes up, as people buy more homes, as the population increases, as Home Depot becomes more efficient, this company over time, year over year, decade after decade, this company will get more profitable, have more revenues, and become a bigger and bigger business over time. Now, not only will that happen, but this company will continue to go up in share price theoretically if this company's business continues to grow. We talked about the underlying business with Caterpillar and Target. The same thing for Home Depot. As this underlying business grows, it is very likely that over the long term, eventually the share price will grow alongside it. Now, not only will that grow, but this company's dividend payment will grow right alongside it. This company has a track record over the last decade or two of consistently raising that dividend at about 10% plus every single year, including in 2021, and they're likely to do it again in 2022. I wouldn't be surprised if they raise it actually over 10% in 2022 now that the pandemic is fully gone. But after all that said and done, what this company also has a track record of doing, like many great dividend growth companies, is buying back stock while paying dividends out. This company announced a new share repurchase program of buying back $20 billion worth of its own stock. And so when that happens, when this company buys back $20 billion of its own shares, multiple things happen. The first one is that the earnings per share goes up. There's less shares available in the market, and so even if this company puts up the exact same numbers year after year, which like I said is very unlikely, even if this company puts up the exact same numbers, long term, the earnings per share will go up because this company has less shares available in the market. The second thing that will happen is that since this company is buying back its own shares, that means that now every day that goes by and this company buys back more of its own shares, there's less shares available, and so that means you own more of this company every day that goes by. Every day that you're a long-term investor, you're a long-term shareholder of Home Depot, your ownership in the company increases every single month, every single year. And so if you owned, let's say you were to buy 1% of Home Depot, of the entire business today, and you were to wait 10 years from now, you might own 1.5% of the business. You might own 2% of the business. And that's the power of share buybacks. And the third thing that happens when a company buys back its own shares, just like we talked about this company being profitable and paying out dividends. If there's a million shares available and a company pays out $1 per share, then that means that every quarter they're going to pay out $1 million. But what if a company is buying back those shares? Now there's only, let's say, 900,000 shares available. Now instead of paying $1 million every single quarter, now they're only paying 900,000. And so that's the beautiful part about a company that pays dividends and buys back its own shares, because not only do they retain ownership, increase shareholder value and earnings per share growth, but also that means less dividends are paid. So that means that the company can even be more profitable because there's less dividends that they have to pay out because that's retained back by the business. So Home Depot, another great reason why I love this company. I was already bullish on the company before, and that share repurchase program just adds a little bit more confidence for me as an investor moving forward going into the decade of the 2020s. So that will continue to be one of my largest holdings, likely for the next several years if I were to guess. But then last but not least, we have the last piece of news here. We have W.P. Carey announcing pricing of its public offering. They are diluting shareholder value. So in the same way that we just talked about Home Depot buying back stock, this company is doing the exact opposite. This company is not buying back shares, they're diluting shareholder value, issuing 5.25 million shares and expected to receive proceeds at about $400 million, $395.3 million to be exact. This company has the option to even purchase more additional shares of 787,000. And what I think is really interesting here is that W.P. Carey is looking at doing two things with the funds. One thing that they're wanting to do is strengthen their balance sheet. They're wanting to pay back debt. And then the other thing that they're wanting to do is they also want to invest back into the business. They're wanting to buy out more properties. They want to increase that net income, their revenue streams. And so I think it's going to be really interesting as a W.P. Carey shareholder. While your value might be getting diluted a little bit, relative to the amount of shares that this company has, it's not any type of massive dilution. It's not like your ownership is going down an incredible amount, but I'm not really for or against it. I'm kind of in between because obviously my value as an investment does go down in value, but honestly, if I had to pick a good or a bad side, I think I'm going to pick that this is a good thing. Because while it sucks to be diluted as a shareholder, while your value in the company did get decreased if you're a WP Carey shareholder like I am, the good news is this is being used for positive reasons. This is a company that is not at the brink of bankruptcy and they're wanting to pay down that balance sheet because they have no other choice. This is a company that is wanting to pay down debt to just be financially stronger, wanting to have a fortress of a balance sheet, and furthermore, they're wanting to just expand further into their business and take advantage of times when interest rates are at just incredibly low levels. They've already bought out a lot of new properties. They've been aggressively investing for the last 2 years or so. And this company, I think, is going to get to a level where not only will its share price recover over the next several years and hit new all-time highs, but I think that dividends, while it's really hard for a real estate investment trust to grow their dividend payment every year, I think that considering that this is a REIT, I think that this real estate investment trust will probably grow its dividends much faster than probably something at like a Realty Income or even a Store Capital like another real estate investment trust that I own. But those were the pieces of news I wanted to go over in this video. Thank you guys for watching the way, and I really appreciate it. Like I said, get signed up with M1 Finance if you're interested. Check out all that stuff down below in the description. Thank you guys for watching. I'll catch you guys next time.